Hey guys, my name is Justin Hodges. I'm here with my colleague Dean Matsui, and today we are talking all about real estate, which we love. Dean, real quick, this is kind of fun. We're going to go through equity essentially, and and
Equity is one of my best topics. That's my favorite thing.
yeah, we love equity. We're gonna take some number. We're gonna give you guys some data here. Then we're gonna grow this into how do you access that equity essentially. So leading into cash out refinances or HELOC or et cetera, et cetera. So let's just hit this fact first, Dean. This is pretty incredible. So according to CoreLogic, as of 2023, this is early 2023 too, which only increased since here. The average U.S. homeowner now has $275,000 in equity in their homes.
Quarter of a
That's
mil.
wild. And so this is the 50 states essentially. Now Dean and I are in Hawaii, so we'll try and talk through some of these numbers out here as well. But that is a healthy amount of equity, right?
Honestly, I feel in Hawaii it's probably double.
It's got to be. It's got to be,
Yeah.
man. So Dean's saying this, guys, because we our median home price on Oahu right now is a little over $1.1 million. So that's life out here. Now the quick math on that is, what if I own a home for $1.1 million in Hawaii? Mathing. And if we rise in value 5% for the year, $55,000 in equity. Now Dean's a homeowner here in Hawaii too, so if he'll probably share some generic data or numbers with you guys too. But Dean, are you happy with your equity?
Yeah, absolutely. Okay, so to kind of give it a little bit of real numbers from Hawaii, right? So my house, I got the loan for my house, I think 2011. So about 12 years now. That was $465,000. And then back then, what I love is back then that was a lot.
Oh yeah, it still hurt, right? It's like, oh,
I mean,
it's expensive.
and I swear to God, I even remember, hearing on the news like the median home price in Hawaii has risen to 500,000. Is that sustainable? Is that, too outrageous? And then here we are, double that, and it's still growing, right? So bought it 2011, 2012, 465,000. Right now, currently, its value is closer to 1.3 million. That's right now. I don't have the greatest house, right? If I were a kid and you told me 1.3 million, I'd imagine a mansion. But here in Hawaii, so many homes have that value, right? And so now it's that equity that I've built up, because I've paid down quite a bit,
right,
since then. I think honestly, I think it's almost 100,000 less that I paid in the last
makes sense
decade. And so now we're sitting on quite a bit of equity. The question is, how do I use it? Right. And I want to invest in homes, right? I want to be Mr. Moneybags and play Monopoly. I want to go collect some properties. I want to go build some properties. So then it's like, how do I use it? I feel like the HELOC is right now probably the best option. You know better than I do. But I will say there's a lot of buyers I know, or excuse me, a lot of sellers I know that don't know what a HELOC is. They don't know what they can do with a HELOC. And because they don't know, they can't see the value and they can't see how it can help them grow. So,
equity is like funny, mythical unicorn type of thing. It's beautiful, right? And it feels good and it's awesome. But then it's kind of trapped in a lot of ways sometimes. Like you're essentially a paper millionaire almost.
Yeah,
equity, you're a millionaire. But you can't, How do you get it, right? Is the question, especially if you're young, you have a long timeline, you want to scale still. There is a theory that equity can be lazy in some ways. If you are in that mode where you do want to scale, you want to deploy it elsewhere and continue upping your net worth, across the board. So there are ways to get to it. Now, you and I both know rates are always changing and they will continue to always change.
Of course.
A few years ago in a low rate environment, I'd probably be telling you it's time to look at cash out refinancing this whole thing. We're going to access all that equity you got, that close, $1 million almost, let's say, at a low interest rate. And so that is effectively cheap money at that point, because you could have cash out refi for 3 to 4%, somewhere in that ballpark. Deploy that elsewhere and probably make a higher rate of return. So again, those periods are unique when they come about, but that's why there's so much activity, 2020, 21, and those couple of years really worth. Now we're more normalized in the rate environment, so it's not quite as easy of a decision. Do I cash out refi and reset the whole thing and pull out money at 7%, 8% now? Or is there a better way to access it? So, I do love the cash out refi across the board almost entirely when rates are low. That's an easy generalized way of saying it. But let's talk through two other ways to get your hands on some of that equity. The first would be the HELOC, which means home equity line of credit. Those rates are usually variable. Sometimes you can get it fixed. Sometimes there's teaser rates in the beginning that are low, and then a higher rate kicks in. So you just kind of want to be careful with these. But that's essentially a secondary loan and a second tier, and it doesn't upset what's going on in your first loan. So you may have a fixed 30-year whatever on your current home lying underneath it. The HELOC is going to be a second with its own monthly payment, its own interest based on rates and whatnot. I like to tell clients we want to open these things up. We want to open it for as long as possible, take the highest dollar amount as well too, but we actually don't want to draw on it until we need it, so that we effectively minimize our costs associated with it. Because if you may have a $500,000 HELOC line open with, I'm seeing like 9 to 12% interest right now on it, which some people will cringe at, but it's there to deploy in so many other ways. But again, it doesn't cost you anything if you don't have a balance on it technically. So HELOCs are not a bad way to open it.
Okay, so let's say 500,000, I can get a $500,000 HELOC, right? I mean, I still do see some of them where, yeah, you get that first year, second year, it's a little bit lower, right? And then the higher rate will kick in. But honestly, even at a higher interest rate, if I'm still paying just the interest rate, my monthly payment is just the interest rate on the money that I'm borrowing.
Yeah,
from
now that you've drawn, not the total,
yeah,
draw the total out. So
yeah. But if we're thinking of it like of using that 500,000 to purchase another property, purchase something that's going to be a buy and hold, and it's going to give us a bit of monthly cash flow, I still feel even with the higher interest rate that you have a good opportunity to still make money.
I'm with you there, because you have to factor in real estate. So you're pulling this HELOC maybe at 10%, let's call it, just for math. And you're like, well, that's going to be hard to overcome making 10%. But when you factor that into a rental property where you have pretty much three things going on, you have cash flow. Hopefully it's positive cash flow if you're doing that deal. The second part is going to be equity in that rental home. And if that just ticks up at 2-3% per year, I don't know why balloons just flew in the background.
It was so random.
I guess when I hold up fingers, balloons fly. I'll zoom now.
Fantastic. I think you need to do it more often.
You saw it too. Okay. And then 3, no balloons.
Okay.
Number 3 is you're gonna also have principal pay down. That's my favorite part. So again, your equity and your rental should rise. Your cash flow should be positive, hopefully. Let's just call it break even for now. And then that third thing too is going to be your principal pay down. The tenant's paying down your principal. When you factor those 3 things in and you give it time and let compounding do its thing, there's a good chance you make more than 10% and you cover your HELOC cost, in my opinion.
Yeah, I definitely think there's the opportunity for it. The biggest thing, like for me, when I took out a HELOC, I had that nice kind of honeymoon interest rate for 3 years. I'm thinking 3 years. Okay, so if it's going to get me a lower interest rate for 3 years, yeah, after 3 years it's going to bump up, but every investment there's going to be a risk. But I find that when it's a hard asset, when it's a house, right? So if I use that money to purchase a house, okay, so for 3 years I know what my payments are going to be, right? Well, after that 3 payments, if we get close to that end, maybe 7-8 months before the end of that, if I'm seeing that the rates for arms and everything is too high for me, well, okay, well, now I'm just gonna look at selling the home. I sell the home, I net the profit, even after taxes.
Right.
I feel like they'll probably cover the HELOC, be able to pay that back. If it doesn't,
yeah, you're right.
Even if it doesn't, it's going to pay it down so substantially that, yeah, even at 10%, 15%, I'm paying $20.
So that's your out. Let's cover. So a couple outs you have in case you get yourself in trouble doing these things. Again, you don't want to over leverage. We want to remind you to not over leverage, of course, with your own, with these things. But a couple of your ways out here is so you can actually refinance the whole thing. So your underlying mortgage, your primary mortgage, and you have a HELOC balance too. You can refinance and wipe that HELOC out, consolidate into one payment at whatever that interest rate is at that time, and kind of recollect essentially, or reorganize or restructure your debt, we call it. The second thing that Dean mentions, you can actually say you're in a further bind, you can sell your home, take the proceeds, pay off the first mortgage and the HELOC, and honestly, you would probably still have some margin left over.
So I feel like definitely it's something that can be a very useful tool. And for both of us, it's a useful tool when used properly and when used wisely, right? Never something you do on a whim. But it absolutely is a great tool to help you scale, help you build. Now, one thing I'm curious, okay, so just to kind of go off on a little tangent on the BRRRR method, right? So buy, renovate, rent, refi. I think I'm missing one.
Rehab. I think, did you say that?
Yeah, well, renovate, rehab.
Rehab, refinance, rent.
Oh yeah, and the last one is repeat. That's the fourth one.
That's it.
But,
yeah, that's it.
So I know a lot of people that have done it. They've used the cash out refi for that refinance. But then the question becomes, like, currently in our, like right now, is it better to do possibly a HELOC in a sense rather than a cash out refi?
That's a great question. It very well could be, because otherwise you're refinancing this into a higher rate than what you might have had it for underlying. Ooh, case specific, I guess.
As with everything. But yeah, I feel like at least know
what else can you do, at that point. The only other thing I'm thinking here is that on the front end, you maybe go after what's called an ARV type of loan or package, and after rehab value with a single close, and you would avoid the whole refinancing essentially. But you still can't afford today's interest rates doing that, really. So I'm the type, I'm a long-term investor, as are you too. We know that with time, a lot of this doesn't even matter what we're discussing, really, if you just sit long enough. So I kind of like having that HELOC open still in the BRRRR method. Yeah, it depends though. Yeah, it really depends on the individual investor, I guess. And do they, how much they're looking to recoup from it all or whatever.
It's always good to at least know the options.
Yeah.
Right. At the end of the day, it comes down to what information you have, what tools you have in your tool belt.
Yeah, I'll even hit you with another option that's kind of rearing its head again. It's called a home equity loan. So it's not a HELOC, it's called a home equity loan. And those are kind of unique because what they'll do is, again, we have a lot of equity in homes right now across the board. We know that, we understand it. Think of this as kind of bringing in a silent partner. They give you a lump sum of cash in exchange for your future equity. And then you have no payments due at all. Whereas HELOC has a monthly payment and interest on it. So they're coming in, they're taking second lien still on it, and they want a share of your future equity over time. So they're basically betting that your home is going to rise in value and it's going to make it worth their while. And they're going to give you a lump sum of cash right now in exchange. So I don't mind those so much right now, to be honest. You can refinance them out too eventually. Sometimes they have like 3 to 5 year holding periods minimum. And then you as the homeowner probably want to buy them out or refinance them out as soon as possible so they don't keep getting a future share of your equity over time. But
is that only on your primary residence, or can you do it on a second residence?
I've seen it on both. It seems like, and I should mention this for HELOCs too. HELOCs typically are easier to get on primary homes, as well as home equity loans are easier to get on primary homes. The reason being, people know that you will continue to upkeep that one better, essentially. You'll make your payments on that. You won't default on that. So rental properties are more risky in that sense from some lenders' perspectives. But, yeah, man, those are kind of fun too, and kind of I'm seeing a lot of those now again. So home equity loans could be another.
Is there any on what you use the money for?
Say that again.
Is there any restriction on what you can use the money for?
No. I mean, it's really the same with HELOC when you go through an application too as well. What's the money for? They're going to ask. I want to take vacation. I want to do something dumb with it. I want to pay off debt. I want to rehab something. Tons of options you'll be given to. So as responsible investors, we don't want to go take that and blow it, of course. We actually want to take it and scale with it more and create more equity and more net worth for ourselves over time and hold more assets. But a lot of people will take it and they'll go to Disney World with it or do whatever. Now you can really do anything with it, honestly. It seems.
Interesting.
Yeah, good stuff, man. All right, let's close out on this one. So in closing, we have a lot of equity across the board in the US. We have a lot of equity in Hawaii, especially on Oahu. That's a good thing. It's part of your net worth. It's very rewarding when you are a homeowner on the one side. So we want to encourage you to buy real estate, guys. This does, over time, it tends to increase your net worth and your financial freedom and all those other fancy buzzwords that feel good. My name is Justin Hodges. I'm a financial planner by trade. This is my good colleague, Dean Matsui at Century 21 Homes here on Oahu. Dean, we're going to plug some links in for you in the video for contact, and as well as mine too. Thanks for your time, brother. To the next one.
Later, guys.